All right, let's dive into one of the most enduring puzzles in all of finance, the accrual anomaly. For years, it's kind of haunted the market, making it seem like investors are doomed to repeat the same error over and over again. But what if it isn't an error at all? We're going to dig into some really fascinating research that flips the old explanation on its head and offers a surprisingly rational one instead. So here's how we're going to crack this case. First, we'll lay out the mystery itself. What is this puzzling anomaly? Then we'll bring in the usual suspect, the idea that investors are just, well, irrational. After that, we'll reveal a completely new culprit, one that's all about rational companies making smart decisions. And of course, we'll look at the evidence before we reach a final verdict. Okay, so let's set the stage. This isn't some tiny, obscure quirk we're talking about. The accrual anomaly is a big deal. It's a well-known, well-documented enigma that has had financial minds scratching their heads for decades. At its core, the entire puzzle boils down to this one very strange question. How is it that companies that report big, juicy profits, what you might call paper profits, so often end up being duds for investors down the line? I mean, it goes against everything you think, right? More profit should mean better returns. So here's the formal definition, first put on the map by Richard Sloan way back in 1996. It's this weirdly consistent pattern where high accrual companies underperform. So what are accruals? The simplest way to think about them is as the gap between the profit a company reports and the actual cold, hard cash that came in the door. It's things like selling something on credit. You book the revenue, but you don't have the cash yet. That's an accrue. So for the last couple of decades, what's been the go-to explanation for this? Well, the prime suspect has always been us, the investors. The traditional view, which comes out of behavioral finance, basically says investors get fooled by shiny objects. We see a big headline earnings number, and we get excited. We don't do our homework to see that a big chunk of that profit isn't cash, and that non-cash part is way less likely to stick around. So investors get systematically surprised when those paper profits just don't materialize in the future. And here's what that looks like. An investor sees a firm with high accruals and thinks, wow, these earnings are amazing and going to last forever. So they buy, pushing the stock price way too high. Meanwhile, a firm with low accruals but strong cash flow gets overlooked. Investors think it's low quality and they undervalue it. The anomaly is simply the market, slowly but surely correcting these mistakes. But what if that whole story is just wrong? Or at least not the full picture? The research we're diving into today proposes something totally different, an explanation that doesn't rely on investors making the same boneheaded mistake year after year. Let me introduce you to the optimal investment hypothesis. This idea completely flips the script. It says, forget about investors' psychology for a second. The real answer to this puzzle isn't found in the minds of investors. It's found in the boardrooms of the companies themselves. It's about smart, rational corporate strategy. Okay, so how on earth does this work? The logic is actually pretty elegant. It goes like this. Step 1. A company's cost of capital, also called its discount rate, drops. Maybe the Fed lowered interest rates. Suddenly, a bunch of projects that looked kind of meh before now seem profitable. So what does a smart company do? It invests. It ramps up spending, builds inventory, you name it. And that wave of investment, it shows up on the accounting statements as high accruals. But, and this is the absolute key, that low discount rate that kicked everything off also means that the expected return on that company's stock is now lower. You see? The higher accruals don't cause the low returns. They're both just symptoms of the same thing, a low discount rate. And this is the big aha moment, straight from the researchers themselves. The trick is to stop thinking about accruals as some shady accounting number and start seeing them as what they really are, a measure of investment. Once you make that mental leap, the whole thing starts to look a whole lot more rational. So let's look at that comparison again, but through this new lens. High accrual firms aren't being overvalued by dumb investors. They're just companies that have cheap access to money, so they're rationally investing a ton. And that naturally leads to lower expected returns. On the flip side, low accrual firms have a higher cost of capital, they invest less, and because of that higher risk, they need to offer higher expected returns. It's a story about economics, not errors. Okay, it's a beautiful theory. It sounds really neat and tidy. But you know, talk is cheap. A great story needs proof. So let's open up the evidence locker and see what the researchers actually found when they tested this idea. And they didn't just run one little test. They came at this from 4 different angles. They used complex statistical models. They tried to directly measure those discount rates. They looked at different types of accruals, and they studied how the anomaly behaves over time. Now, this first test is a real showstopper. The bar on the left, that's the normal return you get from the accrual anomaly. But then, the researchers did something clever. They statistically controlled for how much these companies were investing. And look what happens. The anomaly's power just shrinks dramatically. We are talking about a drop of more than 50%. So much so that it's often not even statistically significant anymore. This is huge. It suggests that investment isn't just a part of the story. It might be the main character we've been ignoring all along. The next piece of evidence is even more direct. The whole theory hinges on this idea of discount rates, right? So the researchers went out and estimated them. And wow, check out this spread. The firms with the lowest accruals had an estimated discount rate of over 8% a year. The firms with the highest accruals, just over 2%. That is exactly what the theory predicts. You know, this new theory also neatly solves another little side mystery. Why certain kinds of accruals, like changes in inventory, are better at predicting returns. The old theory never had a good answer for this, but the investment view does. It says, well, of course they are. That's because a change in inventory is a direct physical investment. It's a much cleaner signal of what the company is actually doing. And what about the fact that the anomaly has seemed weaker lately? Some people say it's because investors finally got wise and arbitraged it away. This paper offers a cooler explanation. It suggests the anomaly hasn't disappeared at all. Its returns just move with the business cycle. It pays out more when the economy is bad and less when it's good, just like other classic risk factors. So, after looking at all that evidence, where does that leave us? What's the final verdict on the accrual anomaly? Case closed? Well, the biggest takeaway here is that the optimal investment hypothesis is a seriously powerful contender. It provides a logical, economics-based explanation that doesn't require us to believe that investors are just fools who never learn. It suggests the market might actually be making a lot more sense than we've been giving it credit for. But, and I love this about the research, the authors are really intellectually honest. They aren't saying the old irrational investor theory is completely garbage. The real world is messy. The truth is probably that both things are happening at once. But what this work does is provide compelling new evidence for the rational side of the story, a side that's been largely ignored for far too long. And that really leaves us with the big, fascinating question that sits at the heart of finance. When we see these strange patterns in the market, are we looking at the quirks of human psychology with all our fears and biases? Or are we seeing the cold, hard logic of economics at work? The story of the accrual anomaly suggests you can't really understand the market without appreciating both.